Now who joins in. Essel Propack reported a good set of numbers. The total income growth was just about 5%, but the margins have improved to 17.5% versus 15.3% earlier. Ashok Goel, the Vice Chairman and Managing Director of the company, joins us now to talk about that. Ashok, good morning and thank you for joining us in the studio. It's been a good margin performance for you, which has led to a 60% growth in the bottom line as well. Just take us through what led to this margin growth, and is this 17% level sustainable?
Yeah, good point. The margins actually have gone up due to a couple of reasons. One is that some loss-making units have turned profitable, so there is a delta effect. Okay. And then certain efficiencies, internal efficiencies that we have brought in, that has helped. Number three, our ratios of oral care and non-oral care category that we service. So there is an improvement of 2.1% in revenue terms, which has improved in case of non-oral care, which has been our focus.
Okay. Actually, just before you came, Mr. Goel, we were talking to Adi Godrej. Their revenues have not fallen much. In fact, their oral revenues have actually grown by, they said 17%. Is it that you can still pick and choose and deliver a revenue growth next year, even if the rains did not oblige?
See, let's look at in case of Essel Propack, we are not just talking about India alone. We have a global presence. India constitutes only about 40% of total revenue. So therefore, yes, India and China, in that sense, constitutes about 60%. So India, yes, the demand have softened up, particularly in the FMCG space that we cater to. And hopefully the rains are not going to be impacted this year. Otherwise, the demand can remain soft as far as Indian market is concerned. When it comes to China, the oral care market has not been growing, but the non-oral care has been growing at about 42%, albeit at a lower base. But another good thing that is happening in China is that there's a lot of premiumization of toothpaste is happening. So as a result, we are able to get the business from the regional and local brands, and that is going to help us going forward.
Okay. Does the rupee hurt if you are 60% dependent on foreign earnings?
No, it's only a translation loss, which actually has no financial impact. All our currencies and revenues and the spends are in the related local currencies. Therefore, we hardly have any $2 million globally unhedged foreign X, which is only receivables again. So dollar is appreciating, so we are keeping that unhedged.
So on the revenue front, by the end of FY15, you've done about a 9% growth. For FY16, what is the reasonable growth that you could see?
See, our target was 15%, and now looking at the way Indian market is, we would expect it to be in low teens. And hopefully the raw material prices will come back again after it has hardened up already. So that should impact the top line growth. So I would imagine about 12% should be our revenue growth. And keep in mind that Europe and Americas are growing for us, for both other geographies.
Okay, 12% is still much better than the 5% that you have reported in
5% is for the quarter, yes. 9% for the year.
For the full year. Okay, what about any acquisitions, since this, it's a distressed time that normally helps you buy cheap?
Yeah, it's a great point, Lata. The opportunities of acquisitions are there. They're mostly in Europe, but that they have also happen to be in Western Europe, which is not the market where you want to manufacture things, and therefore there could be some opportunity for acquisition. For example, some of our JVs where we are not in majority, those could be the immediate targets. We would be starting to work on them. But other than that, I think we want to follow a prudent investment policy at least for next 1 year. which means that our capex should not exceed our depreciation.
Okay, we have actually started a segment where we invite our viewers to ask you some queries. Uday S has written to us from Chandigarh, and he wants to know what is your EPS guidance for FY16 and also whether you will be generous in giving out dividends to shareholders.
Yes, dividend, I think we have already recommended to be increased from 1 rupee 25 paisa to 1 rupee 60 paisa, and mind you, it is on 2 rupees face value of the share. Our EPS for this year, I think, is in the region of about shy of 9 rupees per share, and hopefully we will keep the momentum up. So 20% growth that we think in terms of EPS we will achieve year after year.
Okay. What is your free cash flow and what is your debt position?
Yes, we managed to reduce our debt by 60 crore this year on a gross basis. So therefore, the debt as it stands on a constant currency translation is 960 crores, which is down by 60 crores. And we will continue to reduce our debt levels going forward. As we are following our investment policy, which is not exceeding our depreciation, so we are generating enough cash. So let's say EBITDA figure is about 400 crores. So therefore, we are generating good amount of cash, and therefore we should be able to repay the debts.
All right, we leave it at that. All the best for the quarters to come. Hope you manage to achieve this 12% revenue guidance that you've laid out for us for FY16. Well, that's the word coming in from Essel Propack.